I've been working a lot on project finance of hydrogen and all sorts of different things, and really refining the parallel model UDF so we can get it useful. But this is another video on corporate finance, because where project finance gets really structured and really interesting, and for me, after all of this time of trying to study it, I finally realized, well, what you're really doing in project finance is structuring the debt around the economics of the asset and getting a whole bunch of capital associated with a particular asset at the end of the very, very end of the day. Now, corporate finance, I can't get away from it. It's a lot of magic potion, and the more I study it, the more I kind of go crazy. And what I'm going to do today is, in this video at least, is review the price to book ratio and the cost of capital and how you can do things practically. Now, all I have wanted to do for literally its decades is understand and come up with some magic formula, some formula like CAPM, because we know CAPM is just a disaster. In fact, that's a big theme when you go through CAPM, which is so much the centerpiece of things these days. You just find everything. It just is. The inputs are what completely drives you crazy. So instead of going through a formula, I'm going to go through the relationship between the price to book ratio and the earned return on capital. You can't get anything perfectly exact, but we can start to really study it. And of course, I'm going to go through this file again. I made a video the other day about the Dow stocks and a variety of stocks. This time it's going to be for one industry. Now, I'm doing this partly because I'm doing this project that is I'm not really, well, whatever. I'm making an estimate of the cost of capital for Pakistan. It's all going to be public data, and we had to look at the Damadoran cost of capital and look, oh, here it was 12%, 5%, 7%. This is the country risk premium, which is another subject I'm not talking about. We can look at costs of capital, which Bloomberg, whether they're really estimating the returns people want or the cost of capital is kind of funny, but some places they have 4%. US, they have 8%, India, 18%. They're all supposed to be in USD, by the way. And they used to give you a whole bunch of countries and the feed-in tariffs. And we can look at that, okay? And then I go through, and one day I'm going to put every single one of these databases. I wish you'd start to use this, especially this database where you can get the S&P 500 back all the way to 26 and get it by data. And one of the big themes that I'm going to go through today is, okay, when the price to book ratio is 1, if the return on equity is the same as the same as the cost of capital, and then you don't have to care about the growth rate, then you've got evidence on what the real cost of capital is. And instead, here's another theme for today. Instead of trying to plug in, going to your MBA class and try to plug in all these formulas and plug in things and say, here's the equity market risk premium and all that, we can, and the betas. I'm going to talk about what's wrong with the betas a little bit and what you do if you get daily betas and all that. Instead of doing this, I'm going to suggest you go and you go to, of course, my file. And then you do this sort of thing. You get some graphs of, here's a company in Pakistan. They're clearly earning somewhere, well, this is in rupee, so it's really high compared to the USD, and they're still having a price to book ratio of more than 2 times. That suggests their cost of capital is somewhere a lot lower than this. Okay, and what we're going to do is go through some evidence like that. Now, of course, I happen to be on the kind of low cost of capital side. I'll admit that. And then, we talked about this in my last video. What happens with corporate profits versus the stock price? That's evidence of cost of capital going up. We're going to look at these kind of ratios. His next era, they've got a 4 times price to book ratio and an 8% cost of capital. The cost of capital is below 8%, at least for this company. Now, it might vary up and down, and we have to use a whole lot of judgment, but so what? Let's understand things. Now, to get started with this, I'm going to go through a little bit of here's the Damodaran equity market risk premium. Of course, I'm putting this is public, so I'm putting it on the website, and we'll talk about how you just click on Market Watch and Yahoo, and the beta is supposed to be computed for 5 years monthly, and why does Consolidated Edison have 0.19 versus 0.5? 0.32 versus 0.53, 0.21 versus 0.57, 0.37. What's going on? I thought the beta was like a number, like a real number, and we don't have to go through all this stuff. And here's what. Let's get past the country risk premium and different ways to really do it, and we're going to talk about getting some other statistics on the cost of capital, but this is really what I want to talk about and introduce this video. Now I'm going to, I hope to really nail down the theme here again and again and again, because as usual, you drill down. It's my philosophy even on making a model. Get the stuff at the top and then drill down. So the stuff at the top is here's value. It can be cash flow 1, cash flow 2, and we know that value is driven by cash flow and risk. Risk is discount rate. That's how we get value. We need to do 2 things, forecast cash flow and forecast the discount rate. And if we do that, and if the cash flow was all constant, we could have a perpetuity. And in that case, we get the discount rate from the cash flow and the value. And then you can go back to Mr. Gordon, Dr. Gordon. He was the Canadian, I guess. In 1956, he used to try to promote higher cost of capitals. And he said, well, I can do an integral, or he stole that actually from somebody else. And I know the value is if we have a cash flow, it's the next year's cash flow divided by the discount rate minus the cost of capital. Of course, then you can say, well, cash flow is dividends back in the 50s. That was a big deal, dividends. And then we just reverse the formula around. We put dividends in, we put value for the stock value, and we back into the cost of capital. That's what a lot of people would call the DCF method, and they can do 2 stages, and you can do all kind of fancy stuff with that. And then here's in our tool that I'm going to give you. I've made a lot of effort here. That's why, and I don't think nobody's asked me to download it. Oh shit! I wish somebody would get a little tiny bit interested, because I track what kind of growth rate the market suggests, and in this one, maybe I have to increase a little bit. Here in the past, the growth was negative. They say the past is 1.24. The market's it's going to be 8%, 12% next year. Okay, maybe. All right, they probably get that from company estimates, and guidance and all that stuff. Okay, and then where am I? I need to go down. So we can get that, and we could try to use that for the growth rate, but that's going to really mess things up, frankly. Okay, or we could put a formula in, our growth rate formula. I hope I put my growth rate. I guess I didn't put the growth rate formula. I put that ROE times 1 minus the payout ratio. So you instead of doing that, you can add this. And the question, especially for this industry, is what happens if the ROE changes? But you can get this cost of capital in terms of a formula. Okay, not so difficult. Alternatively, you can reverse this formula out and put the growth rate in and put the earnings and get the dividend payout ratio here and try to apply it with a growth rate and an ROE. And we have the famous, basically, it's just backing in to the value driver formula, what I call the Mckenzie Formula, which I've railed about a lot. But when we use this formula, we can say the value per share instead of talking about, here, I guess I got to go back. Instead of talking about earnings here, times 1 minus g divided by k minus g, it's so easy to prove this. I meant to kind of show it to you. Just you use the growth rate formula and you use the Gordon's formula. It's so easy. Well, EPS is ROE times the book value per share. So you just substitute that in, and then once you have the book value per share and the market value per share, you get the price to book ratio. So here's where I substitute it in, and then you reverse it around, and you get this formula. The price to book ratio is ROE minus growth divided by cost of capital minus growth. And if you don't have to be super mathematical, I hope, to understand that if the cost of capital and ROE exactly the same, no matter what the growth is, this is the same as this, top is the same as bottom, that's 1. And when this is equal to 1, cost of capital equals ROE. Now, applying it to companies like Tesla or something that are making all sorts of different ROEs, or Amazon, will be very tricky. We're not going to be able to do that. But applying it to food companies, electric utility companies, which I'm using, stable, boring companies, UPS or something, I guess, companies that McKinsey uses in its book, because that's all this valuation is based on kind of boring companies, you can start to try to understand it. Okay, and then and then I go on, and I am so obsessed about this one, but I can't quite get it. Because when we look at you can graph do a little scatter plot of the price to book ratio on the bottom, ROE on the side, find out when it's 1 and get a cost of capital, make a slope, and you want to get this line just right. And if you're really careful, you've got to incorporate the growth rate in that formula. That would be my dream. That's what I always wanted to do, to get this price to book, to get a nice little regression and say, aha, I've got a way to do this other than the CAPM. So now I am going to kind of open 2 files, and now I've got to remind myself. So I said, well, we're discussing the CAPM, and just illustrates the wackoness of all of finances. CAPM is now a central piece, and the whole thing you can't get inputs for. And my idea is to just try to use this market to book ratio as a complete alternative. And I'm going to show you how it works with companies, and show you now practical ways to get real data on this and just get some indications without putting that regression analysis and all that, and also demonstrate some stuff about PE ratios and EV to EBITDA ratios and growth and distortions and all that. Now, I think that will probably be enough. I am going to talk about why betas give you different answers. That's going to be, I think, in a second video. And the other thing is, I've been getting more and more people who make these files with zillions of spreadsheets. And in my file, I do something really, really bad, just horrible, and I get a use the indirect function just all the time. Let me see. I just grab stuff from these sheets with indirect, and I have to clean out the trillions and the billions and the thousands and all that. But these are just all sorts. Not in this one. Just a minute. I think maybe in this one. I'm sure I have some indirects, and that's a bad thing to do. Okay, that slows you down. Sorry about that. It really slows you down. But then, if you are really careful to compute sheet by sheet and just focused, you get the data in a sheet and you don't recompute that sheet, you recompute others, you can start to make these mammoth spreadsheets efficient. And I have these friends, there's Sean Morgan, brilliant man. Oh my gosh, is he brilliant? And how he can manage these big spreadsheets with new little Excel techniques. For me, being able to recalculate only what you want. Now this is the international one, which we'll come back to. And I have to say something else. It's worth repeating. If I want a company in the UK, here, China, there's a company in China, but they somehow report to the UK, Germany, XE is Deutschland, I think, and Spain and Finland. You can get the information, and you can get the kind of 5-year information and just pop it in, and you don't have to buy Bloomberg or anything else. I just think that is an enormous change. So I made sure that we can look at some international utilities. Why don't I start with this? I'll start with this one instead of the other one. Okay, I was going to start with the US one. So what you do is you download this file, which I haven't really posted very well up to my website, but you download this file. You put in your ticker symbols from MarketWatch. You put in your ticker symbols from Yahoo. And what I have done is I've learned that sometimes I want the Dow, sometimes I want airplane companies, airlines, sometimes I want mining companies, sometimes all the others. And you just kind of keep a little database of these ticker symbols so you can quickly copy the data symbols. And then sometimes if the currency is different for the financial statements in MarketWatch from the Yahoo currency, you have to make some adjustments. And what you do is you clear the sheets, read the financial data. That can take a long time. I'm sorry. In this case, I'm embarrassed how long it took. It took, I don't even want to show you that. It took something like a long time. I had another file open, so blah, blah, blah. It can take 30 minutes or something. You got to maybe have another computer or watch a video or do whatever you want, turn it off. It is a pain. Okay, I'm not saying that. And then you read the stock prices. That takes no time. And you read some exchange rates. And then you're done. And then once you read those, of course, I've shown you you can get all this data to make a little model. And this is where I'm going next. Once you have the quarterly data and you just switch to a different company, and this is the company from China, from Germany, from US, and you just get all of this stuff, and you've got all the balance sheets and financial statements to make a model. That's one of the big things I wanted to do with this originally. Okay, and now I've spent a lot of time to make sure we get all the quarterly data structured really well, or structured easily, so we can do a little analysis by quarter or by year. Okay, now the first thing, based on my little introduction, the very first thing I would like to do is look at the return on equity. And here we go. I computed the return on ending equity. And then I'm going to put right next to that the price to book ratio. Now these things, here's the big deal. Once you get the data, I am embarrassed to say I don't know how Bloomberg or anybody else works. But all I want is the data in Excel so I can start doing my own studies. I can start doing my own graphs. I can start doing my own things. Maybe I should make it a little bigger. Okay, and then once we do this, we do our little drop down boxes. And I've been emphasizing because I've been going crazy with Excel bureaucrats. Oh, they're good, maybe sometimes. Audit the models. Oh my gosh, put this spreadsheet here, this sheet here, this. Oh God, input S, input C. Yes, okay, I give up. All right, but you know, and never use these things. That's totally disallowed, not allowed. No, this is. Did I that's bad. You should never set the scales to zero. I don't know even why it is. This is I started with this is utility companies, but I started with Tesla because I thought, oh, what's going on there? We can see what kind of return they've been making, and then you can kind of look and see what the EBITDA is. Now, of course, if they're only making 3% return on equity, oh, look, their price to book ratio is enormous. And I suppose I'm going to cheat a little bit and put well, let's look at their EV to EBITDA ratio. I can't do that because they had negative EBITDA. Oh, shoot, maybe I should have done this. And we can't really look at a price to book ratio. So that was pretty stupid to do. And I'm going to put the price to book ratio back. Okay, and then we can look at what's happening in their EBITDA. And when I do this, we do it year by year and then quarter by quarter. The growth rates are by year. And we can see, okay, here's what the market thinks they're going to grow at in the next year in their earnings. So we can quickly start looking at their earnings and say, okay, here's what they've grown at. Do you really think they're going to grow that fast? And you can. It's kind of I'm sure it's kind of interesting. And can I find the return on ending equity? And now let's go to Apple. Apple has this price to book ratio that's exploded. Their equity has gone way down. That's probably why. And you can't even kind of get their return on equity if you look at Apple a little bit more closely, though, and look at maybe the return on invested capital, which is really, really high, but you really start looking for them at a little bit of their, well, let's look down here. I've already got it. Their growth rate in EBITDA, they didn't grow all the way, and then they had a new iPhone, whatever it is, and then they've gone up, but really is their growth justifying these kind of returns? That's the ultimate thing. And why can't you do some fancy regression analysis on this? I would love to, but it's gonna be really, really tough. And let's get the okay, return on equity again. Now let's go to Amazon. Now Amazon, of course, well, that's kind of interesting. The price to book ratio is about the same. The returns were really kind of low. And you can really see, of course, here the growth, the dramatic growth. If they're earning a high return, that's what Tesla wants to do. They want to earn a high return and grow the company. Oh, there's the EBITDA growth. So we can look at that, and we can, I hope, look at revenues. And it pushes it down, so you can kind of try to really assess what's going on with the revenues, and if they grow. It's not a complicated formula to say, okay, let's put in a revenue growth, some margins, some capex. Here, the interesting thing for Amazon is that they really are spending some money on capex. I think they're unlike some of these they're really spending a lot. Can they keep making these returns and growing? And what's the implied cost of capital if you have to, and you better make some long run growth that's not the historic growth, because they'll very quickly take over the whole economy because they grow big, and as you go big, just like you go fat, if you go really, really fat, you explode. I'm getting too fat. Okay, now we're finally getting into some of our utility companies. Here's really one of my favorite companies of all time in Malaysia, and because they sometimes let me go over there, and they're really nice people, and you can see when they're kind of earning this return, and please, you can't look at this year by year. You have to. This market value, of course, is based on the expected growth. They do have no, they don't really have any. A little bit of estimates that you can even get for some of these companies from Market Watch, not from Yahoo. This would be really interesting. If this is a stable kind of expected return, this says that the market thinks their cost of equity is about 6%. That is really, for me, really, really interesting. And if you look then at the cost, this is now our quarterly statement. I've got debt to capital there. They've got, and of course, you can adjust these yourself. Oh, I should make power pivot or something like this. And then let's look at something like their average interest rate. Now I tried to do that quarterly, and I don't know what happened here. Their interest rate kind of went up. Maybe I'm contradicting myself a little bit, but this is kind of interesting. If you think the cost of debt versus the cost of equity, and why did I thought I had the debt to capital here, and we can do that on a book basis or a market basis, and I guess that's their interest expense has gone up, but then I took the wrong company. Okay, their average interest rate. I am so sorry about this stupid little stuff here, and I can't get it. No, I got to get it. I'm not giving up. Okay, but I wanted to show you that. So they're paying about 4 and 5%, and you can say, that doesn't. Is this really 6%? And what we should do is we can do this kind of thing. Format data labels, and let's put a percentage in, okay? And please. Okay, and they kind of give you a default. So, okay, their cost of capital is somewhere around 6%. And then we keep going. And of course, you can change all of these. And this is, again, I don't know how much I have to say this. Now, they're earning a very good return. Whether they can sustain this, maybe. I don't know enough, and their price to book ratio is 2 times, so we can kind of look and try to get the different analysis, and we can look at what the EBITDA has been. It's kind of gone down. For me, that would scare me a little bit. Oh, look, we even have some expected growth rates from different people and onward, but we can see that their cost of capital is certainly a heck of a lot more than that. Almost swore. RWE, I would love to take this thing out, but if I do, I won't. At 4% here at kind of at these low cost of capital, they've got a market to book ratio above 1. And where is the evidence that they're going to have a higher return than that? And so that's an interesting one too. And the fact that you can get these for just companies all over the world. Now, that's the cost of capital in euro because everything's in euro. And here's one of the more interesting one. This is this next era, which has the highest market value of anybody. You can kind of see, well, okay, here is some historic EBITDA. The past growth is 11% because they built a lot of new projects, and they're expected to grow by 8%, which is a really good growth rate for utility. Their earnings have come down. We'd have to study exactly why, but their price to book ratio is enormous, suggesting an extremely low cost of capital, suggesting there's this powder of money going into these renewable investments. Korean Electric Power, and why is this? Do I again have this problem with no? There, I think I might have missed the balance sheet on this one, and this is very frustrating because I know this. I know this problem because they had it in thousands. Okay, I'm gonna have to skip over that one. Here's for me one of the most interesting ones: Consolidated Edison, a nice, beautiful, boring company out of New York. For distribution, they have a market to book ratio above 1 and a ROE of about 5%. I don't know what happened. Maybe they got a rate change or something, and maybe this is constant, and there's expected growth of 2%. This looks all pretty good, nice and boring, but it's evidence of a really low cost of capital. Okay, and then let's kind of switch over to this one, and we can kind of see how here's their EBITDA growth, and I thought, I wanted to put the debt to capital maybe, but the average interest rate is somewhere around 3%. And you can say, oh, why is the cost of capital not that much different than 3%? Remember, this has a little bit of downside. It's got some historic stuff in there. And this one is based on an expected number that can go up and down. It's a pretty safe company, really. Okay, I didn't explain this. This is another German company. We've got a really high market to book ratio. Let's skip over that one. And Finland, and it's just amazing. You can just kind of get all of this stuff. Again, Iberdrola, I can't even say them right. 10%, 2 times market to book ratio. We're getting, it's pretty consistent. The idea, some Portugal renewables, these ROEs are pretty stable. This one suggests certainly a cost of equity below 7%. Let's look at this one. Let's look at kind of what we have for these ones. They're borrowing at 1%, because they're in the Eurozone. And here, this one. Oops, this one was a little bit higher. So, okay, interesting. And then I should stop, but I just love this too much. And here's one in Hong Kong. Just about 1, and 6%, a little bit higher. Okay, good. Maybe a little bit higher cost of capital here. Okay, something wrong with that ratio. EDF, another wonderful company, and we have bouncing around ROEs, so it's much more difficult to tell with this one because we need some stable ROEs. NL in Italy, and let's just continue, Duke. Okay, they must have had a write-off or something like that, and we can do this. Now, you could also do the same sort of thing. Okay, this is getting too much. I think this is clearly getting a little bit too much. And I don't know what happened. Sometimes, I've got to really double check. I automatically did some of these things. This is a company in India, and in Spain. Okay, I hope. Then now let's. That's enough. So you just. I'm putting not only am I putting these files, but I'm putting my little collections of ticker symbols, so you can kind of do this stuff, and it's never ending. This is a never ending project. Look at this. I didn't automatically change the scale, which is a pain. So now I'm on. No. Okay. I hope I'm on. Well, it doesn't matter when I'm on. When I download this stuff, you can also go to that Yahoo stuff, and you can then get this is where you get all the forecast. And on the website I explained, if they change the damn position of which variable goes to where, you can do all of this. And it's not that hard because I've done it a bunch of times. You get the whatever the dividends, and I try to get the forecast. I haven't been drinking, I promise. The forecasted return on equity. Here's a beta, and the rest of it. Okay, and then you go, and here is I started summarizing it. And you can summarize it however in the heck you want, but this is where you can get the beta from Yahoo, and I verified this beta. And you get the beta from MarketWatch, and this is kind of interesting. I haven't looked at this one. Here, this is 0.21 for Yahoo, and I don't know how exactly they do this, if it's against the S&P 500, which it should be, I think. And you can kind of get a handle and look at how much different these betas are. This is the one I showed you, and sometimes we can't get them, but it's pretty good. And of course, then you can also get the PE ratios and study the PE ratios, and that's all another subject. But before I finish this one, okay, I just want to, I was going to go through the whole U.S. utility one, but I don't think I have to. I haven't put them up here yet, but I'm going to put a whole bunch of these stupid files with Dow, with airlines, with mining, blah. I already told you. So you all you have to do is, if you want to update things, you got to clear the sheets. Press this one, takes 40 minutes. Press this one, takes a couple minutes. Press this one, it takes a couple more minutes. And then you're done, and you have all of these, and you study them. And if you want to go and find this. So let's say I want to find the data for, here we go, this company. You'd use this is just a conditional formatting, a controversial thing. You press a macro, and it kind of goes here, and then you go and it'll just, you can see what the assumptions were made for the income statement. And this is just downloading straight from MarketWatch. We go back to the place, and we can, I hope, we can see the stock price too. And the stock price, sometimes it's not in the same currency as the financial statements. I think that happened one or two times here. And then what I do is have to make a little adjustment. And we can go to data, extract stocks. And what it does is it just brings all this data and puts all the stock prices together. Look at this. This was clearly Korea Electric Power had some really high stock prices, and that should have been perhaps divided by the won to the US. That's why I put those things in there. And then you have to put kind of the adjustments for the currencies in. Okay, now in the course of doing this, I've studied a little bit the Ibbotson data, Ibbotson, not Seinfeld, that's a different one, right? When you I'm going to go back to chapter 1 here and go to the stock prices for a minute. When you download the S&P, you can't get it into an Excel file, and you got to do some tricks to get the data, but you can get the data and then demonstrate here this craziness of calling a 10-year a bond a risk-free bond. What nuts! Here's the volatility, and because of the changes in the cost of capital, and you can see that the Ibbotson study has almost exactly the same. as the, oh, I didn't even put it here. This is the study for the other one, and we can see that it's almost the same. Let's press the F11, and we can kind of really you can get all the data yourself. That's what I'm trying to say. And I'm going to have a whole nother video on why a beta for a daily stock price is different than a beta for a monthly stock price, and why there's the markets do not they do don't if markets were perfectly efficient, you would never find any mean reversion. The mean reversions mean you can predict things from past prices. That I learned that in the 80s or 70s or sometime. Yeah, and with this data, you can really test these things, and that mean reversion is what causes these betas to be all messed up. And people don't study this, and they don't study that the risk-free rate really isn't the risk-free rate. They don't study the betas. You can get all different answers for it. They don't check the data against these formulas and prove things with a market to price to book ratio, the kind of things we've done. And I better calm down because I do like making videos. Sometimes I don't make it enough, and it's not that long.